Welcome to this explainer. Okay, so today we are jumping straight into the incredibly confusing economic indicators for 2026. We're going to map out three very different yet highly plausible paths the stock market could take. Look, if you've been watching the charts lately and feeling completely lost, trust me, you are absolutely not alone. We're going to impartially dig right into the data, look at exactly what the optimists and the pessimists are saying, and break it all down so you can actually make sense of it all. To really understand where we're headed, we've got to look back at the frankly bizarre reality of the past year. Someone recently summed it up perfectly, saying 2025 felt like the economy and markets were playing a giant game of financial chicken. And honestly, they hit the nail on the head. It was just an incredibly confusing time. On one hand, you had consumers swiping credit cards like it wasn't even real money. And on the other, you had short sellers, especially the ones betting against giants like Nvidia, who probably aged a full decade in just 12 months. And this perfectly captures the massive divide we're seeing right now. We are caught in this relentless tug of war. In one corner, you've got the bears, the pessimists screaming that a recession is right on the horizon, pointing out all these underlying economic cracks. But then, in the other corner, you have the bulls. These are the optimists, buying up artificial intelligence stocks with the kind of frantic energy usually reserved for the last Pokemon pack on the shelf. The momentum has been absolutely undeniable, even if the reasoning behind it feels a little stretched sometimes.
So, to help you form your own conclusions, here's our agenda for today. 1. The bear case, focusing on overvaluation. 2. The bear case, looking at a top-heavy market. 3. The bull case, focusing on economic tailwinds. And 4. The uncomfortable gray area.
Let's kick things off with Section 1, the bear case. Overvalued. Are we just pre-ordering hope? I want you to think about this single number 31 times. This whole AI mania hasn't just boosted a few tech companies, it has dragged the entire market upward with it. Because of that, the S&P 500 is currently trading at nearly 31 times earnings. To put that into perspective, the long-term historical average for the S&P 500 is around 16. So yeah, we are currently sitting at almost double the historical norm. That's huge.
When we dig into the raw data for these major tech players, the multiples are just staggering. I mean, Nvidia is trading at 47 times earnings. Palantir sitting at a massive 400 times earnings. And Datadog is up over 430 times. So the crucial point the bears are making here is that at these levels, investors aren't really trading on fundamentals anymore. They're just paying unprecedented premiums based purely on the hope of future growth. If these trading multiples ever normalize back to historical averages, the resulting drop wouldn't just hit AI stocks, it would likely drag the entire broader market down right along with it.
Moving on to Section 2, the bear case, top heavy. This is the group project where two people do all the work. You see, the S&P 500 isn't being lifted evenly by 500 different companies. Far from it. Just 7 massive tech companies, the Magnificent Seven, make up over a third, or 35% of the entire S&P 500's market cap. Even crazier? In the first 3 quarters of 2025, those few companies accounted for over 41% of the index's total returns. What's supposed to be this broadly diversified index representing the entire U.S. economy is quietly turning into a highly concentrated and potentially super fragile bet on just a tiny handful of tech giants. The bears point out that this creates a really dangerous feedback loop fueled by passive investing. Think about it like this. Step 1, these big tech stocks grow larger in market cap. Step 2, because most major index funds and ETFs are market cap weighted, every time new money flows into those funds, they automatically have to buy more of the biggest companies. Which leads to step 3. The broader market becomes increasingly concentrated. It's a beautiful cycle when everything's going up. But if those massive tech names stumble even a little bit, a 10% pullback in one stock bleeds heavily into the broader indices, dragging your supposedly diversified portfolio down with it. Now, there's a major caveat to this whole bear case, summed up perfectly by the famous economist John Maynard Keynes. Markets can remain irrational longer than you can remain solvent. Statistically, yes, we are overdue for a 10% pullback. Historical data shows the market tends to correct about once every 3 years. But listen, going short on the market just because you have this logical gut feeling that it's overvalued, that can absolutely bankrupt you. Being right too early is essentially indistinguishable from being wrong. This rally can blindly continue far, far longer than logic dictates. That brings us to Section 3, the bull case. Tailwinds. Why the market might continue to rip. The optimists out there aren't just relying on blind faith. They're looking at two very distinct, very powerful engines driving this market. On the monetary policy side, we have a central bank cutting interest rates. And on the fiscal policy side, we have the federal government continuing to spend trillions of dollars. When you combine these two forces, you get a highly, highly supportive backdrop for stocks.
Let's break down the monetary side first. After ending 2025 with 3 consecutive rate cuts, the expectation going into 2026 is for even lower interest rates. And lower rates mean cheaper capital, right? Cheaper capital allows businesses to borrow and expand a lot more easily, which in turn leads to higher stock valuations. When liquidity loosens up like this, risk-on assets suddenly come alive. Investors are just so much more comfortable paying premium prices for future earnings when they know capital is cheap and readily accessible.
Then you add in the fiscal side. The United States government is currently running a deficit of over $1 trillion annually. Now, while economists love to debate the long-term consequences of that debt, in the short term, the effect is totally undeniable. It acts as a massive economic stimulant. All this spending puts money directly into the system, propping up corporate revenues and sustaining consumer demand. It basically creates a cushion that can keep economic activity high, even if other parts of the economy start to cool down. So for the bulls, this combined liquidity and spending means the market has plenty of fuel to just keep right on growing.
Which leads us to Section 4, the uncomfortable gray area. This is a scenario nobody is positioned for. You know, it's just human nature to want a clean narrative. We want a spectacular rally, or we want a dramatic crash. But what if we get neither? What if the market doesn't melt up and it doesn't crash? Right smack in between the raging bulls and the pessimistic bears lies this highly frustrating middle ground, where capital just endlessly rotates back and forth between different asset classes without making any real forward progress at all.
Honestly, a long, choppy, sideways market is arguably the absolute most difficult environment for an investor to navigate. Think about it. Every 2 weeks, the financial headlines completely flip. A rally starts, you get confident, and bam, it immediately stalls. Then a dip happens, it feels terrifying, but it never drops quite enough to offer genuine generational buying opportunity. It's this eerie price action where there is zero clear momentum in either direction, and pretty much every move you make feels wrong. So the crucial takeaway from this whole gray area scenario is this. In a sideways market, the absolute biggest threat to your money isn't an economic crash, it's your own emotional fatigue. When the market goes nowhere for months on end, investors get bored. They get frustrated. And that's exactly when they start making impulsive, impatient decisions. They abandon their long-term strategies just to feel like they're doing something. Surviving this kind of market requires immense discipline.
Ultimately, no one, no analyst, no economist, and definitely no algorithm has a crystal ball. The absolute best strategy you can have right now is to absorb the data from all sides. Understand exactly why the bears are terrified of valuations. Understand why the bulls are happily riding the wave of rate cuts and government spending. And prepare yourself for the very real possibility that the market might just grind sideways to test everyone's patience. The information is in your hands now. Based on everything we've looked at in this explainer, which path do you believe we're heading down? Are we about to break, soar, or just chop sideways? It's a fascinating puzzle, and I'll leave it to you to solve for your own portfolio. Thanks so much for joining me today.